Bring that ass back like a boom, 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 boom.
Hello everyone, this is Supernova. You're with Boom Traders Weekly Overview. Today is September 11th. It's the 36th week of the year. Now let's get it going with the session overview. As usual, risk vest first, tactical trading environment second, and take a look at the current markets in my notes, and then we're going to do a summary. So let's get it going with the risk vest. Right now we are on buy caution, and when we get to the charts, I'll explain what we mean by this. Here are some of the components that do make up the risk vest model. This is the general market. Right now is on positive. We had this rally since Tuesday and Wednesday. We have the up down volume being positive. You can see the changes here. So it went from neutral to positive for the general market. That's a 1 plus. Up down volume went from negative to positive with 2 pluses. New highs, new lows is neutral right now, and stock participation is at neutral. As far as the tactical trading environment, we put it on caution. I wouldn't say it's an easy dollar environment, although if you caught the lows on Tuesday and Thursday, you should be sitting in very good profits right now. But we have to remember that this is pertaining to the short-term trading environment. And if you look at even the midterm or the long term, they are both really bearish right now. So I wouldn't put it as an easy dollar environment when we have the midterm and the long term on bearish. So we also have to treat pretty much every rally like sell up affair to resistance points like the 50 and the 200-day moving averages. So it's really important if you are trading in this environment. You have to be cautious and look for resistance to the upside when the market can actually resume its trend, because we have to respect the longer term trend at all means. So this is for our models, what they're showing, and now let me take you to the charts, and we're gonna slice and dice the indices and the internals, because there's some very interesting things that are happening. So let's get it going. Now, first things first, I want to go through TradeStation charts. There are some things that I cannot show you in Thinkorswim. So the first thing I want to show you here is the correlation between the three. We can also say Dow Jones is an important ETF or indice, but it's only 30 stocks, so it's not much of relevance to the entire market. So let's go through the three more important indices: the S&P, Nasdaq, and the IWM, with their respective advanced decline lines and net new highs, net new lows. So the first one that I want to show you here is the S&P 500 using the SPY ETF. We made that bottom on Tuesday. I had that buy signal on Wednesday, which was confirmed on Friday, and the market moved higher. Now, what is important to notice here is the first thing: the advanced decline line is corresponding with the market rally right now. But what is important, and I noticed it when we were doing this in late July, right here. If you look at the market. Let me just catch that. If you look at the market is making a positive low, which means that this low is higher than the previous low, whereas the advanced decline line on the S&P 500 was not. So it was downward sloping, whereas this is making an upward slope. And you can see this resistance we've been using to call the bottom right here on Tuesday. What we see right now is advanced decline line is also moving in context with the price. So that's the good news. The bad news is that we're still not seeing proliferation of net new highs, net new lows right here at the bottom of my chart. If you can look at it, we are still not seeing that many net new highs, net new lows showing up right here. If we have a lot of new highs, you can see it's major green right here in the rallies in 2019, 2020, 2021. It's been all like greenish, and now we are trying to budge here. But you would think that with the strong rally the market made, there'll be a proliferation of net new highs, and this is just not the case. Now, I'm not saying that the rally will stop where it's right now with 3 days in the rally. This was very oversold situation right here, so a bounce was due. But I'm just saying that don't expect miracles here. So this is for the S&P 500. Nasdaq, we have the QQQs. Same story. You see, like I went in on Wednesday with the DQQ right here in the first day. My signal was on Tuesday. I went right here on Wednesday. I purchased the DQQ, but you can see right here that net new highs, net new lows is still negative for Nasdaq. So even though we had this marvelous rally of 3 days, we are still making more lows than we're making highs, and this has to worry you a little bit. The other thing is that the advanced decline line is really not lifting this much, and if you look at the price right here, so let me just draw a horizontal line right here below. You can see that the advanced decline line is pretty much working with this low right here on this line, whereas price is making higher highs. So basically, advanced decline line is not really confirming the strength in the market right here. Now, I'm not saying that this is necessarily a bad thing, but I'm just saying that you have to be careful. And as I said in the introduction of this presentation, treat this rally more like sell-up affair. Cover some of your long positions. If you want to initiate shorts, think about where some logical resistance might occur. And when we look at the thicker swing charts for the indices, I'll show you some levels. The last but not least, IWM. IWM is the one that actually recorded higher net highs than net lows, and it's been rallying. It was one of the stronger indices looking at it. Advanced decline line is also moving in line with this. There is a upward sloping move for the IWM advanced decline line. So all things are looking pretty much well right here. Now, this is what we have for net new highs, net new lows, and the advanced decline lines, if you're so interested in. One thing that is important is VIX. So at the top we have the S&P 500, at the bottom we have VIX. Now VIX crossed the midline of the Bollinger Bands, which was very good. It closed on Thursday below 25 with minor spike and then just shoved back below. Now I'm really expecting this. If we can move and go to about 18.5, 19 right here to shove it up with the lower Bollinger Band, that would be amazing. Although you have to remember, as I said, we are still in bear market, so I wouldn't be surprised if we stop right around here as we are right now, and with the S&P 500 around 410, 409, and then we have another leg down. I wouldn't be surprised, so be careful, as I said. As far as my one of the oscillators that I use here on TradeStation, I just cannot reproduce that on Thinkorswim, so that's why I'm using it on TradeStation. You can see that my level of 70 is like overbought level for this. That's the number of that. Well, that's the percentage of stocks above their 20-day moving average, and this is all stocks on United States stock exchanges. So this is all stocks at the percentage above 20-day moving average, and right now we're sitting at 32%. So we have 32% of stocks are above their 20-day moving average. Once we get to 70%, then that's a stochastic right here. It's a slow stochastic indicator. Once we get above 70 right here, and this becomes overbought, you can see there's almost an immediate downturn. Same thing right here. We were oversold in these zones, and the market just started turning. This started turning. Also, stochastics was oversold to the downside. So that's one of the oscillators that I use for market timing. We still have a long way to go, so we may not stop here. I would prefer not to stop here, but as I said, we're in a bear market nonetheless. Put call ratio briefly went above 1, and this is a moving average of the put call ratio, so it's the exact put call ratio days are right here. You can see them with those green lines, but what is important here is this average. It briefly touched above 1 right here. That's the 6th of September. and now we're going back. So the put call ratio is going down, which is good. And this is what I have here from TradeStation. Now let me take you to Thinkorswim, where we're going to look for some support resistance in two of the important levels that I'm watching on a weekly basis. Okay, so now we are in Thinkorswim. This is my market monitoring screen for the day, and let's first turn our attention to S&P 500. Now I know how this looks. It's a little bit jiggy jaggedy, and there's a lot of lines. So let me zoom in and start explaining things. Now, first of all, this level right here, 390. If you can see the bluish level right here, 390. This level we gave you in chat on Monday. So you had this level all day through Monday, and you can see that the market respected that level amazingly. That was on Monday. We had this sell down to the level, rejected. Tuesday, tried to poke it, and here's my buy signal on Wednesday for the S&P 500. I told you on Wednesday we have the S&P 500 bounce signal. We had this resistance to the downside, and we have this level of support that we identified on Monday before market opened. So right now there's all the reasons for you to go and buy some. Now I'm not gonna say buy a lot, but buy some. We moved through the 50. You can see right here, this is very strong bullish action right here. 3 days of elevated volume above their 20-day moving average. If you are follower of IBD, they use the 50-day. I prefer to use the 20-day. We gapped over the 50-day, which is this yellow line, and we just moved higher from it, which is quite positive action. We also blew through the upper line. Here's the resistance that's supposed to be a 308. Let me just now 308 is Nasdaq. This is on 402. Sorry. Let me just on the right. Yep. So we have this zone right here for 250, and we just blew past it, which is very positive, and we can expect the market to move higher. Now, the first area of resistance is obviously the 20-day, which comes at 410, and then we have another area right here around 413, 414. Now, I will change the color. This one, make it cyan, because this is major resistance for us, and we should be looking forward to see where we can get there. Now, if we get there, I'll definitely reduce some and look for some shorts if the signal appears. So this is what we have for S&P 500, 413, 414, major level of resistance. Go to QQQ. As I told you, QQQ is making net lows, more than is making net new highs, so we have minus 49. Here is what we have on QQQ. Again, this downward support, hit it. We undercut it right here. This is the level 292. I'm sorry, and here's the 308 that I was talking about. 292. We had this on Monday as well, and right here on Wednesday we have this buy signal. So I took some TQQ, as I said, right here on Wednesday when we moved past the highs right here, and now it's comfortably in profit. I also bought Tesla, had the same signal, but this level was respected incredibly. Now we are getting to, and let me just put it so you can see the level 308 right here. If we can move past it, then the other resistance is show it on the right. Let's change the color. You can see the other resistance comes at 315.76. So 315, 316, that's the other resistance that I have. If we are able to move and close past this 308 zone, that's the QQQ. Last but not least, let's go to IWM. In IWM, pretty much the same thing, blew past this line right here. We had this support on the lower side, but 178, the level that we mentioned in chat on Monday, held perfectly. So you can see Tuesday and Thursday, Tuesday and Wednesday's actions. I'm sorry. So on Wednesday I had this buy as well for IWM, and you can see gapped over the 50 line, same fashion as the S&P 500, bursted through the upper zone. Now it's important to see if Monday we can close and remain above the zone. And if we could, I'll probably be looking for resistance somewhere around this area, which is, I'm gonna just draw a line right here. And I know I have a lot of lines, but can't help it. That should be price line number 9. Let me just make it bold for you so you can see the levels. So we're talking about 192, 193 as being obvious place where we can find some resistance. Now, this is what I have for levels. I want to take a look at some of the oscillators that I use, and you can see this ZBT, this is Zweig breadth thrust. I was able to code it here in Thinkorswim, so it's easier for me to use it. The other two, we are approaching short-term oversold with one of my oscillators already on the oversold. Now you use overbought. I'm sorry, this overbought levels with, and you saw that the stochastics and the percentage of stocks above the 20-day moving average has still a long way to go, and it's more of a longer-term oscillator. The other one, these here are more like short-term oscillators. You can see all three of them were giving us, and this is the SPX, SPY, were giving us indications that this market is oversold right here late last week. This is on Friday action, and you can see Monday started turning around, but they were giving us indication right here on Friday. So, as I said, be careful. We're approaching the midline on the Bollinger Bands. We are slightly overbought right here. One of the oscillators, this is pushing forward. This is almost overbought as well. So be a little bit careful with initiating long positions right now. I would say the perfect time for doing this was Tuesday and Wednesday when we had all the signals. We already went through the markets. Now going to nodes, and this is one chart from Sentiment Trader. I think that it's been circulating around quite a lot. One of our respected members in chat, Street Junkie, posted it as well. This is the institution's traded net speculative options premium billions, and these indicates hedging to extreme level. You can see last week's panic hedging was 3 times more extreme than in 2008. And this, alongside with the sentiment, which recorded almost historic low for the bulls. This is American Association of Individual Investors recorded for the last week ending. You can see September 7th, 18.1% of bullish sentiment with 53.3% of bear sentiment. This is the second highest since April. You can see 59.4 in April. These are all contrary indicators, like people are really scared, and that's good especially for oversold bounces. This is good. You can also see the CNN Fear and Greed Index. It was on fear last week. They update this daily, daily during the week. So last one was on September 9th, but you can see we moved from fear last week to neutral. And Bitcoin actually moved higher in price, but Fear and Greed Index dropped 26 from 28. So people are fearful, and we have this extreme level of hedging. We saw the put-call ratio moving above 1 late last week as well. When we have this extreme hedging and we have this extreme bearish sentiment, it's also good for oversold rallies like the one that we're having right now. Now let's talk about the Feds. Here is a website, and it's the Fed Watch tool. I'll post the link in the description of the video. This is a place where you can basically monitor the expectation with the statistics and the probabilities of what the rate hikes are going to be. Now we have, as of right now, we have 91% probability that the Fed hike will be 75 points. This is on a yearly basis. So right now we currently stand at 225, 250. So with 75, we're going to get to 300, 325. And there's only 9% probability that the Feds will hike 50 points to 75, 300. You can also see for next month and so forth and so forth. It's a really an interesting website to play along with. You can see that there is absolutely 100% chance of a hike, no change in these, absolutely zero probabilities. And I want to talk a little bit more in depth about the options that the Fed do have. Now, the first thing that we have to understand that this hiking cannot go unlimited, and we cannot go higher than probably about 3.5 to 4%. The only reason that we cannot do this is the amount of debt. There's an extreme amount of debt, and that will bring about an extreme amount of defaults. So we cannot go higher with the rates just because this will put more pressure on debtors, and the amount of defaulters will probably basically crash the market. Now, we all know that although Fed said that they would like to keep inflation, below 2%, and they don't really care about the markets. We all know that's not entirely true, and you pretty much, if you have unusual whales or other option activity services on your Twitter account and so forth, you pretty much hear every day about insider trading from Congress and so forth and so forth. These people are loaded with stocks, and they don't want to crash the market. Now, I know that some of them are more speculative trading options, but what it's at the end of the day, you have to understand that nobody wants to crash the market because the market is heavily invested in politics in the United States. So we can talk all day long about Powell's desire to tame inflation and stuff like that, but if it comes at the expense of crashing the market, I doubt that they'll allow this. Just as a side note, China, that they have problems with their construction companies going into extreme amounts of debt that they cannot pretty much pay off. They just injected 30 billion US dollars in the sector to fight this debt. So the Fed's, the way it's shaping up, they have a couple of options, and I've tried to list them here. So the option A, first, the option A, of course, the CPI and PPI numbers come lower than expected, which is good for everyone. And then Feds, seeing that, they are given, an incentive to basically lower the hikes, pretty much going 50, 25, 25 by the end of the year, achieving that 3.5, of course. But the problem with this is that all math calculations show that 3.5% rates are not going to bring down inflation to 2%. You have to understand that there's inventories that are spiking, consumer demand is slowing, and so forth and so forth and so forth. And that 3.5 rate is just not going to be enough to bring down inflation 2%. So I think that option A just, irrelevant. Even if the CPI and PPI numbers come in lower than expected, I think that they're still going to go with the 7.5. Option number 2 is Volcker or Volcker. I'm not quite sure how to pronounce the guy's name, but in the 1970s, he just started hiking rates, going into the teens to reduce inflation. The problem is that Powell does not have the market conditions, the macroeconomics situation in order to do that, just because of the depth. And also, when Volcker, I think it's probably Volcker, but when Volcker did it, the rates were higher. So he didn't start from zero, hiking it up. He started from high rates, and he had the room to go into the teens. There's virtually no debt, especially when comparing to nowadays, 50 years later. And Powell does not have this option in terms of, there's not being enough debt. There's huge amounts of debt right there, and people are struggling with paying back. So hiking the rates like Volcker did, I think it's highly unlikely. And third option, which I think is the most likely event right here, is we sort of stimulate another crisis, whatever it is, so we can go into quantitative easing. Now, as I said in the very beginning of this slide, I think that we all have to understand that Powell is a politician. He's surrounded by politicians, and those politicians play on the market with insane amounts, and they are part of it. They don't want this market to crash. So no matter how much we would think that it's probable to crash, we still, in the back of our heads, have to remember that those people don't want the market to crash because they're profiting off immensely. If I have to choose an option, I'll probably go with option C, just because of the way I am. But the thing that is important right here to remember is that we need to follow stocks. We need to follow the market, and we had those perfect buy signals here on Tuesday and Wednesday. We did some buying. Stocks are doing good. So if we just follow the market, the charts, and the stocks, I think we'll be better off than trying to interpret what the scenarios for the Feds are going to be in the future. So pretty much with this, I'll finish this presentation. Do a quick summary. Here's the res vest on buy caution. Setups are selective. The market is definitely in a correction, but I have it in greenish color because it's a positive correction. Put volume lowered since last week. Volatility lowered with VIX closing at 22.79. And of course, we have the recession. We have the Fed hikes. We have to remember those when we're talking about macroeconomics, and we're talking about the situational awareness of the market where we are right now. But it's good to try some, have some in your portfolio, because there are pretty much two ways that this one can go. We can go to some of the levels that I gave you, or go to a resistance level and just undercut the lows later this year. Or we can just, blast off here, try to consolidate for some time and, make new highs. Now, understand, also I forgot to mention September, but I think this has been, reoccurred and it's been, repeated constantly on all forums and Twitter and so forth. September is historically the worst month to trade. Worst returns in September. Its market usually goes down turn before it actually turns in October, November, December, and so forth. Close really, really strong to New Year's. And the other thing that you have to remember, we're in the second year of the presidential cycle, which is the worst year of the 4-year cycle. So just remember those things when you're making your trades. But as I said, be guided by what the market is doing and what the charts are telling you. Don't try to interpret all the news and all the things that are happening in the world, because the market is discounting mechanism and it might surprise you. So I hope you liked our presentation. If you have any questions, drop us a comment here on YouTube, or we'll be very happy to have you in our Discord server, where we have amazing community of traders, bounce off ideas, and make some money. At the end of the day, it's about making money, right? So if I don't see you in Discord, I'll see you here next week for another market overview. Stay safe, have an amazing Sunday, and happy trading during the week. Bye-bye.